So that's one of the things that I would look at is as we get into earnings, what stocks are coming out, what are they hitting? And then, any one of these I can go into, if I just pick any one of these stocks, I go into this and I can go over here under the overview and say, well, what else is in that group?
This is the How to Trade Stocks and Options podcast, brought to you by 10MinuteStockTrader.com, where we cover finance, stocks, options, entrepreneurship, education, and money. And here's your host, voted one of the top 100 people in finance, Christopher Uhl. Hey there, traders. Welcome back to today's How to Trade Stocks and Options podcast. Today, we have a special lesson for you. I'm putting it here on the podcast because I really believe that this is going to provide you massive, massive value. And that's what I'm trying to do here. And hey, listen, if this podcast was useful to you at all, I really highly suggest that you go check out the full trading course at AIStockTradingSystem.com. That's AIStockTradingSystem.com. Hey, make sure you subscribe and hit the bell so you'll be notified every time we give you more tools, tips, and tricks to help you trade faster and trade smarter every single week. Hey there, traders. Welcome back to today's How to Trade Stocks and Options podcast. Today, we've got two of my favorite guests back on, Rance Mashek and Chris Mercer from Market Gear. We're going to be talking about earnings. We're coming into the earnings season now, about a week or so away by the time that this airs. But what we're going to be covering is just the earnings season in general. So not specific advice, but just some tips and tricks. And I told Rance I've got about 100 questions I'm going to ask him as we go through this. So guys, thanks for coming back on the line today.
Glad to be here.
And before we get too deep, let's make sure we tell everybody about Market Gear. So Market Gear is a platform that we're going to be talking and working through today as we go through all of this. You can get your own free trial, 2 weeks free at marketgear.com/Chris Uhl. That's me, CHRISUHL. And you'll get 50% off your first month. So with that being said, let's get into this, guys. So we've got bank earnings up first. And so earnings are not something that I play now. I used to play them. I got burned really bad, as we were just talking about in the last episode. I've experienced all the ways to do things wrong. I'm sure I'll share that at some point in this, but I don't play earnings anymore. It just, for me, it feels too gambly. It feels like I've lost control, and it feels like I'm hoping the stock does something versus just following a trend. So tell me what your opinions on this.
So I look at earnings a couple ways. First of all, I like to see, I tend not to trade the very earliest of an earnings cycle because I want to see how things are starting to shape up and then tend to play off of that. Now, my one exception to that is, and we've talked about this a few weeks back about a straddle play where I can make money either way. Then I just need to find something that has a very high probability of moving, and work with that. In general, though, that's a bidirectional trade, makes money either way it goes, but it has to move a lot to make it work, right? So you have to find the right ones for that. So, like Amazon has a tendency to move a lot through earnings. Tesla has a tendency to move a lot through earnings. So you got to find the ones that have these, big heartbeats during an earnings report. If you're going to play earnings other than that, some of the things I like to look at is what's happening in that sector and, how is that sector playing out and what's still coming up that's in that sector that I could maybe take advantage of and be able to ride. So that's an element of how I tend to approach it. I will tell you that I tend to try to play the bullish side a little bit more than the bearish side, although if you got a bad earnings cycle coming in, you play the bear sides. I mean, the one thing about it is when they miss hard, and the stock, shows that, right? So things tend to go down quicker than they go up, right? So It can be a great way to play on the downside. Although in the last, decade, that there hasn't been exactly a whole bunch of horrible earnings windows out there. There's been a couple of rough ones, but so that's what I tend to look at. And one of the ways I do that here is let me share real quick on an element of our platform. So this is the Market Gear platform that I was talking about. And in this, one of the things we have is calendars. Those calendars for earnings, splits, and dividends.
Oh, nice.
Yep. So
I need that. For you. Hang on. I've been burned a couple times on stupid dividends, like a day or two after I put it on, getting hit with the dividend. Hang on. Not selling it, but like, well,
you're right.
You got to deal with the dividend price change.
You have to deal with the dividend price change and a dividend is a reason for an early assignment on options, right? So if you're short an option, you can have that happen. So just as a quick point here on this, what we do show.
How did you get to that real quick, Rance?
Right. So it's just find. And so we have several ways to find trades. One of them is the calendar. So find calendar, right there it is. And then it'll show you the dividends on any particular day, what's coming up. But also if you go in on any particular stock, what we do have here is when the next dividend, when the next ex-div date is. So this one's April 22nd. So you can always do a quick little check to see if there's an upcoming dividend, even on the research page for that. So you can know exactly. So we have that, and we have earnings. This will show you a number of 8 days to earnings, actually. And then a dividend, we show you the ex-div date, which is the date you really care about for this, even though the adjust date, but that's the date you really want to watch for. All right. So, so in the case of this, what we have here, though, let me go back to the earnings side for just a second. Right now, if you look at, now I have the S&P 500 up, right? And if you look here, coming up next week and the week after, look at this. Actually, if you look at the 29th, 63 stocks of the S&P 500, more than 10% of the S&P 500 is announcing on one day, right? And then if you just take that whole week, you got, you got 30% of the S&P 500 coming out the week of April 26th. And then if you go into the following week, you also see, there's quite a bit coming out that week as well, on the average 40 each day. So you've got that earnings season right there coming up. Now, one of the things about this, if I go into any particular earnings day, I can see what stocks are coming up and what the estimate is. But if I look at this, let me just show you something real quick. If I go back to January, and I look at that same window, right? So earnings season, January, April, July, October, right? So if I look at this, at the earnings season here, let me just pick one of the days, I can see here on that day what the estimate was and what the actual was, and we color code it based on whether or not they made their number or not, and by how much, right? So if it's this brighter green, they beat the number by at least 10%. The darker green, it's closer to the estimate, and then same thing on the misses. But if you look at this, you can tell here that overall some strong earnings quality coming out, right? They're beating their numbers here on that date, and you can go back to another date and you see the same thing. So now what I would do, this is how I would approach, one of the ways I'd approach this is, now that we have earnings season coming in, right? So as next week starts to shape up, I'm going to be able to see how some of these are coming out. Now, mind you, everything I'm looking at right now are just the S&P 500 stocks. Right?
Yeah, so, actually, I was just going to say, this is really cool. I wish I'd known about this sooner.
Well, it's a pretty cool, because as soon as they come out, I see the estimate actual variant, right? So if I go back just a couple of days here, I can see what happened here with, these hit their number and so on. So as we get into this earnings week next week, I'm going to start to see how things are shaping up. And as I see how things are shaping up, I can extrapolate that in that this will, so if I start to see, AMD doing well, there's a good chance Intel will play a similar, right? It's the sector or industry group it tends a little bit to kind of, play together there, because that industry is benefiting from whatever's happening at that moment, right? So now it doesn't always work that way. You can have AMD do great and Intel miss, but at least you have a little bit of, go with the flow. So that's one of the things that I would look at is, as we get into earnings, what stocks are coming out, what are they hitting? And then, any one of these I can go into, if I just pick any one of these stocks, I go into this and I can go over here under the overview and say, well, what else is in that group? Right. So the industry group. So I can click on that and I can get a list of all the stocks that make up that particular group, and be able to do some things to look at. Well, okay, if this is doing well, what else in that arena could I also take advantage of that's doing well, to try to stack the odds in my favor a little bit? Now, you still have some of those same risks, but if it plays well, you've got kind of that driving force to be able to keep moving it in that direction. So that's one of the things that I would do. And Chris, I don't know if you want to jump in on any. Well,
I was just going to say also, if you hop back to the calendar, obviously he was showing you the S&P, but it's really easy also to switch. If you want, let's say you're interested in the Russell 2000 ones, which sometimes have a little more volatility. Now you've got the Russell and which ones are coming out, or you can do the entire market, everything you want by selecting all equities, or, even just the optionable ones, whatever you want.
Oh, cool.
And and they're all there. So if you really, by the way, since we are talking about option strategies today, the optionable ones are useful as well, right? It shortens the list up a bit, so you don't have to worry about stuff that I'm really interested in this one, and then you figure out that you can't go do an options play on it anyways, right? So
I got to tell you, having all of this in this spot right here is one of the coolest features I've seen. I mean, it seems so simple, but then like you don't have to go research this. You don't have to go other places. You don't have to go type in all the different symbols to check. It's just like, boom, right there.
And you know, as Chris mentioned here, that, you know, since we primarily trade options, why look at anything else, right? You know, so I know the S&P 500 pretty much that's all optionable, and but Chris brings up a really great point. If you're playing volatility plays, you know, that's a great thing to you know, open up that window a little bit. And again, all optionable. And, you know, we talked about the 29th being a big day for the S&P 500. Well, look at this. Over the course of these 2 days, right, over 500 stocks are coming out in 2 days, 700 for the week of the optionable stocks coming out in 1 week there. And so again, let this week be my shaping up week. How's it looking? And then go find, you know, similars that we could potentially take advantage of in my bigger week here. Right. So this is my kind of lead in week. And then my you know, my action week is one of the ways that I would look at that.
Oh, this is really cool.
Yep. By the way, you can also, another way to do it, this does some of that for you because it visually shows it to you. But I don't know, Rance, you want to hop into the screener? Because in the screener, you can also talk about, let's say I want to see stocks, you know, I have all the parameters and yeah, optionables, obviously there'd be one. And if you expand it out to the third level, you know, you can also put, you know, forward next earnings dates and stuff like that. So if I want to see stocks coming out next week or whatever it is, and then still plug in a bunch of other variables, right? Stocks above their 10-day moving average, or stocks above, you know, all these different things. There's your future earnings date one there, right? I can screen the market myself, make my own screen, and still apply when's the next earnings coming out if I want to look for stocks that are going to report soon. So it's a little different than the calendar itself, which is just showing you the dates, and then you kind of get a list, right?
And by the way, if I want to do that, and then, you know, we've talked a few times about getting in during relatively low implied volatility, so I can also you know, bring that into play, right? So right now I've got you know, things that are in the you know, I can look at the low part of its range. I can look at things that are coming out with earnings. I want to make sure that they're optionable, you know, do that. And then when I'm ready, go in here and I can say, yep, I want optionable. There's 4,500 stocks now that are optionable. I want days to earnings to be, you know, no more than 21 days out, but at least 7 days out. So I now have, you know, that window, and I'm going to leave the date part open here. But then, you know, I also want it to be within a certain part of its IV range. So let's say I want it to be from 0 to 50% of its IV range. So now, so now I've just limited down the stocks that much more. I could even do other things to limit it by price, whatever. When I'm ready for that, shows me that. And I've got my list of stocks here showing me when the next date is, and all that stuff to be able to work from, all right within this. So it's kind of a cool, the screener lets you really, you know, versus just the broad calendar. Now you can like really funnel it down, hone it into really what you want. And then once you have these, you can save those, and they're readily accessible whenever you want them. So it's a pretty cool additional way to take something like the calendar, and now let's whittle it down to get to a nice tight list of stocks that we want to look at.
Well, I know, like, for anyone who trades earnings, you know, making sure that they're aware of things like this, things like dividends. I can't tell you, like, in the last month, I put on 4 or 5 different trades just for them to immediately, so I use Tastyworks, and then the little D shows up saying, oh, there's a dividend coming up. And, you know, I'm buying long stock, or I'm, you know, buying long calls or something like that in the money long calls, or maybe even selling put spreads. And all of that works against me, you know, because the stock price will go down by the amount of the dividend. And it's like, if I'd waited 24 hours, basically it would have reshuffled. And then I would have had the information I needed to make the trade going forward at the new market price. So this is absolutely something that I'm going to start putting in this calendar in my my selection criteria. I'm really, really glad that we talked about that.
It is kind of nice too that you can look on that dashboard page here just real quick and see when the next earnings, when's the next dividend. It's right there readily available to you. I will tell you that a lot of the trade finder scans that we have in the system are designed very specifically to consider all of those things, right? Like, our bull put spreads, for example, our trade finder for bull puts, there will not be any earnings between the entry date of that and expiration. There won't be a dividend between the entry date of that and expiration. Now, what that does is it knocks out a lot that the prices actually look good for, but why take on that extra risk? Right. In a case of a bull put where I'm going to take in maybe a 10 to 20% risk reward ratio, that means I have 80% at risk. Why would I want to play that going into an earnings where if I'm right, I got a 20% upside, but if I'm wrong and it collapsed on me, I have an 80% downside, right? It just doesn't make sense to me to risk 4 times what you're getting through that kind of an event, which is why in the case of bull puts, we watch that. Other things, I know we have one coming up on ratio back spreads. Well, that's one that's a great one to play because if it goes up, you're great. If it missed earnings and it collapses, it's somewhat self-repairing. So we'll tease that for the next session coming up. So it's a strategy you could apply to it as well. So really, a big part of it is look at what this is my approach, and I 100% agree with you here, Chris, about watching out and playing earnings, right? And you mentioned you're not trading it right now. What I would offer is that if you don't have an effective approach, not trading through some of those rocky moments is absolutely the right thing to do. So cash is, the odds of losing your cash are slim, right? So be careful how you approach, but if you take the right approach in the right market condition, there's a great way to be able to go. One of the things I talk about in diversification is you want to diversify in different stocks, different sectors, different industry groups, but also in different strategies, right? Because if everything you're doing is somewhat bullish and the market does a major pullback in options, you can get really hurt. If I have some ratio back spread, some straddles, some bull puts, well, now I might get hurt on the bull puts, might get, neutral on the ratio back spreads and made some money on straddles, which is, by the way, what happened to me March of 2000. That's exactly what I was set up in. I was a bunch of bull calls, a bunch of ratio back spreads, and a bunch of straddles when we walked into March of 2000 when the tech bubble popped. And I ended up basically not losing anything when people around me were devastated.
Yeah.
Right. And so that's an important approach to this. So same with this, as we're talking about earnings, what's the right approach? What's the right strategy? If you think you're bullish on it, you want to give it room to move. So I would not be doing a bull put spread where I'm taking in a 20% of the spread amount. I'm taking in, $1 on a $5 spread where I have $4 at risk through an event like earnings. That's not the right approach, right? Doing something where maybe it's a bull call, where it's out of the money bull call, and you've got a large upside and minimum risk. If you have that risk tolerance, okay. Ratio back spread, straddles, things like that can be good. Simply buying stock and expect on an upward expectation, or synthetic longs, something like that if you want to. But those are definitely approaches you can use as well. But how do you stack the odds in your favor? And one of the things for me is I don't trade the first week of earnings. I let that show me, except for my straddles, right? Because we've talked about that before. So straddles I do. But other than that, I'm really looking at what's the market showing me. Are they beating their numbers? So how's that playing out? Because it tends to play out within the same sectors or industry groups through the earnings cycle in general. Again, there's some risk factors, but that's how I'll generally approach it: is let it shape up and then do it accordingly.
Yeah. And to me, a lot, obviously the key when you're doing any type of trading, but specifically around earnings is if you're looking at a stock for whatever reason that you're interested in doing some kind of an earnings play, the determinant factor to me on what type of strategy you use should probably be revolve around the implied volatility, right? Because if you've got low implied volatility coming into earnings for whatever reason, or maybe it's because you're taking on a position like a couple of weeks ahead of time and it hasn't really started to kick in yet. You remember what happens is a lot of times you get all these different earnings, and there are people out there, they just play earnings, right? So it's like, oh, we got these coming out on Wednesday, so on Monday let's start buying some options in case this happens or this happens, and that's when the implied volatility explodes, because they all start buying all these different options, and then 2 days later it's over, but they're already working on the next stock that was coming out on Thursday and the stock that's releasing next Tuesday, and they're just moving, and that's what pushes the implied volatility up. So and maybe this is something, Rance, you could come up with examples here on the fly. Let me put you on the spot. But if you have low implied volatility coming into earnings, what's a solid strategy to look at that would be beneficial if there is a move on earnings? And then if you have high implied volatility, it's not going to necessarily be the same strategy, because you're really looking to take advantage of the fact that the options are kind of overpriced at that point in time. Is really what it comes up to.
So just to address as we're talking about, let me flip back over to the platform for here just a second. One of the things that I would share here is, as I go into a particular area in options. Now, we've been using a lot of times, we use the options chain as we're doing things, but one of the cool things is there's all these templates as well. So if I wanted to look at, a bullish strategy, like a bull call or a bull put, it just gives me the template for it and how I'd be able to approach that. Right. So it's kind of a nice little way to do some of this. So, again, if I have an upcoming earnings, I'm going to look at my implied volatility, which is right here on here for you. You can see where it's at. Like in this particular case, the blue line. Let me clean this up for people that aren't familiar looking at it. The yellow line is the average. The blue line is the current. So it's really just off its low of implied. That the red is a 1 year high and 1 year high and 1 year low. So it's relatively low here on. I just happen to have EFX up, but as you get close to that, it's going to go up. So that's where you're going to start to shift it. I will tell you that there are strategies that you can do right before earnings when implied volatility is really high, where you can do something like a condor. You suck in all that premium, and if the stock doesn't move too much, you can make money. The problem is if it moves, then you get, you're getting hit pretty hard. So how do you work that? I'm going to tell you personally, I'm not a big fan of, I know there's definitely people that do it and do it successfully. I'm not a big fan of condors through earnings, just because if it does move on you, you can get hurt pretty bad.
Well, it goes back to what you were saying just a couple of minutes ago, the whole, risking 10 to make 1 or risking 9 to make 1 on an iron condor. And that's where I stopped trading earnings. Actually, I had been under the impression that the real only way to trade around earnings is to sell an iron condor, boxing in the trade, go out greater than the quote expected move, and the expected move being, 85% of the at the money straddle price. So let's call it, if it's $10 wide for the at the money straddle price, you go $8.50 if you can, either direction. And, I had some success and some losses with it, but the day that I stopped was there was an earnings trade in AKAM. I don't even remember what company AKAM.
That's Akamai gaming company. Yep.
Yeah. So I traded that, and I was like, okay, this is great. It was within the expected move. Like I said, it was a hope scenario versus like just following the trend scenario. So it was fine, and the market opened the next day. And I'm trying to get filled. Let's say I did a $5 wide spread. Let's say I sold it for $1. I'm trying to get out for $1 or 50 cents. I'm trying to get out for 40 cents. It's not happening. I'm raised up to 60, raised up to 70, still not getting filled. And I'm like, this should have worked. I don't know what's happening here. And I'm like, I'm just going to hit a market order. And I got filled at like 350. So my profitable trade immediately went to super unprofitable. And it was, like,
even though the options prices weren't that far out of whack at the moment, right? It was like,
right. Yeah. But just hitting the market order and watching it go, it got filled at whatever was there. And I was like, this super sucks, right? Like, this is not how it should have gone. So I was like, I'm done with earnings. Like, there's no point. It's too much stress for not enough return on me. So I'm done.
So what you bring up an interesting point here. I think it's something that's really worth mentioning as you're talking about earnings play, because, you talk about specific with that strategy, but if you look at it as a whole, one of the things that's going to happen right through earnings is a lot of times those bid-ask spreads widen a little bit.
Mhm.
right? And why? Well, the market maker's job, to create liquidity, but they don't want to take on risk. So every time they take a trade, their immediate move is to hedge that and get to a delta neutral position. Sometimes they'll have a bias, but basically they want to neutralize the risk. Well, when there's a whole bunch of demand in one thing and not so much in another, how do you balance the supply demand? Well, one of the things that they'll do, one of the things you do is adjust price. But what they'll do, especially in options, is they'll widen the bid-ask spread. So now you're in a situation where you got in this for a credit, you're trying to get out right after, and it just isn't working, even though it's in the sweet spot, even though it's right where it needs to be. But you know that the probability of it staying there is slim.
Right.
Right. And so you're
I gotta
trying
get
to get
out of
out, right? You got to get out of here. And it's difficult to do because of that very factor of those widening bid-ask spreads. And that's something that you do have to watch out for. And again, I am also not a big fan of straddles on earnings. Condors on earnings. It's like the opposite side of that is a straddle, right? Make money either way it goes, but it has to move enough. That's why I want to get in low implied volatility. So all of these can work. It's a matter of right thing, right time. But I always look at, what's my risk reward ratio, and look at my probability here. And if I have a high probability the stock is going to move because it's going through earnings, and I don't have enough of a risk reward ratio in, let's say, a Condor to really take that on, I'm going to tell you, I'd probably be at a 50% window of that I'd want to be in potential gain on a Condor to go through an earnings report, because again, probability, right? I have an event that is, if you just look at like standard deviation, whatever, for probability, you have an event, you have something happening that can be a driving force, and that's what you want to watch out for. So that's why one of the things I tend to like to do is I tend to play a trend, but I let the trend establish in the first week of earnings, right? Because like kind tends to be, if you look at it, a lot of times like kind tends to perform similar to to its industry group or sector. So that's how I'll play it out. Use that first part to let me get an idea of what's happening. And then I still have a good solid 2 weeks of plays that I can go in and be able to take advantage of. And a great way to be able to do that is that earnings calendar that we're talking about. And then I see what's doing well in that for that first week. And I go, oh, well, what else is in there? And I can go in any stock and look at who its competitors are, or what else is in that industry group, and then look to be able to take on trades from that perspective. And again, I want good, strong reward to risk ratios, not things like condors and bull put, stuff like that, so that I can take advantage of that. And if I am wrong, I don't get hit as hard. So
right.
My approach.
And maybe today what we could do is let's go to the calendar, right? Let's screen by the S&P like we started out. Let's pick a day next week, right? And click on a couple of stocks. Not that we have preset. We haven't preset any trades that we wanted to set up here. We wanted this to be more of an open analysis discussion, but maybe get into a couple of stocks and then go look at them. Let's see what the implied volatility looks like. Let's see what some of the risk graphs would look like for different types of trades going into earnings, and see if anything looks to make sense.
So just as a first of all, what I'm going to do here is I'm going to go with ones that are expecting to go up, right? I'm not going to do with NVR because it's 4,000. We're probably not in that, right? So I'll just take one of these here, come down a bit, and grab this, throw it over to research here. And, then I have that list of stocks here that I can start to work with, right? So if I look at this is Snap-on.
By the way, you did that, Chris. Did you catch that? We grabbed. He went to the calendar, grabbed a stack of 8 stocks or whatever it was that he was interested in, and in one motion threw them all over into his main list so he could start researching.
No, do it again.
Okay. So here. All right, so if I go to my calendar, I sort this however I want to sort it, right? So in this particular case, I'm sorting by strong earnings expectations, right? I choose a price. I'm not going to go with the 4,000, right? So we'll come down here. We'll take this one here, SIVB, and then come down to some point, right? However far you down based on the earnings number, whatever, we'll take it down. What I did was to Snap-on here. And so I just told, standard highlight, shift, hit. I've got those highlighted, and now I'm going to send that whole list over to research, and right there they are. Right now I do, because what it does is it shows you the list of the last 20 you've looked at. What I always do is start with the last one, because I know what that is, but by the time I get there, I'll forget. right? If I start working down the list. So I work here up. So I have a Snap-on, and I go, look at this, right? So we can see here, by the way, EPS is highlighted red. It means it's coming up soon. Tell me 9 days out from this. Let's go look at options here. And now if you look at this, my implied is still, if I just get rid of this, my implied is still low compared to where it has been. So then I would look at strategies that could take advantage of that lower implied, on a trend. So if I came into that earnings and I saw some things in this arena moving up, then I might want to look at, is a bull call going to work out for me? And if you look at this here, look at this. If I did, that just happened to be on bull call. I got 60 days out. On this, right at the point where if it goes up from here, I'm going to make money. I got 119% gain potential in the trade if it trends up. And that's not counting the benefits of implied going up and all that. So we could take advantage of something like that in this. And it's right now kind of from here on up from that point, right? So it's, and again, you see this is 66 days back. Look at what has moved in the last, 66 days. And so if it moved that same thing in the next 66, we'd be way up into our profit zone. Right. So, so again, it's a couple things that you can look at on this. If I just go look at here's, CE, actually, this is kind of fascinating. Look, again, relatively low volatility. And a lot of times on straddles, I say a week and a half, 2 weeks out, because it's the implied still kind of low. And we can see that, again, just kind of cleaning it up for us here right now. It's actually at a very low implied volatility.
But by the way, look back 3 months on that implied volatility and look what happened, right? When that's your last earnings right there, that spike above the yellow line is 3 months back. So you can see that this stock is fully capable heading into the last couple of days before earnings of picking up a lot of implied volatility, which means the options pricing is going to get more expensive on both sides no matter what.
Right. Which is actually a really fascinating thing. If I were to talk about, we were talking about, so this implied volatility right now, let's say it's been up to around 46. So if you just watch this really quick, if I go in and did a straddle play and I go over to my thing here, and if it goes up to 46, right, watch what happens to this trade.
Oh, that's a big difference.
That's a huge difference, right? I mean, I'm sitting at, if it went up to 46 right now, I'd be sitting at, somewhere $500-700 profit in the trade. Just
the stock hasn't even moved.
Hasn't moved, right? Just on the increase in implied volatility, right? And so those are things you want to look at coming into these and how you might want to play it. And, you see, it's kind of cool to be able to go back and see that. By the way, on the main chart, you can also add an implied volatility in here so that you can see how that's played out over time. So you can go right back. Look at right there's the earnings. Right there's where that's at. That's that spike that he was showing back there. Previous earnings right up here. Where again the implied volatility was 43 on that one, 46 on this one. So you can immediately see how it behaves around 49, the previous one, right? So I can see what those implieds tend to be, and use that as part of my analytics on this, on how I want to do it. So I just want to say we're kind of bouncing around on a couple of things. Here's the thing about earnings. There's a lot of opportunities in earnings, and you can get burned in earnings. So what you want to do is it's a couple of things. Watch your reward to risk ratios. Watch your probabilities. Right? If your reward to risk ratio, I want a high reward to risk ratio on any trade I'm doing on an earnings, because there are times you're going to be wrong, and you're going to be wrong in a hard way. And so you don't want to be, a 10-to-1 risk to reward ratio, right? Where I have to rewrite 10 times to make up for one miss when I have a driving force of earnings to be able to do that. So great way to be able to do this is you can look at, you can look at what's coming up with earnings. You can then find as they come out, you can then go in and find other stocks like that stock. Once you know what the actuals, again, if I back up a little bit here, I have to go back to the previous, but the actuals are, and you can see our companies tending to hit or not. And then again, be able to see how those are reacting to that, and then play the forward on it. So again, next week would be a great week to shape up for that, to play stuff the following, that are coming out the following week, as I see how the earnings cycle is starting to shape up. So,
well, speaking of the earnings cycle starting to shape up, there's something going on in the markets right now that I really wanted to get your opinion on before we head out. What's going on with volume? Volume has been drying up. I don't know if enough people are really talking about it, but it's one of my screening candidates. Is that, basically I just want to see that the volume is over like average volume, but like nothing is over average volume. I mean, you go through like almost the entire S&P 500, including the SPY, and the volume is depressed like 40%, 50% of like average volume. Mm-hmm. So what's going on with that? What
that's I don't that's a little off. It is compared to what's been going on in the last 3 months. But keep in mind something, until basically until December, even though and volume was strong last year. Honestly, let me talk for a minute about Nasdaq volume because it's something that I follow specifically. But I mean, you can see it in the New York side too. Nasdaq volume last year was way up. I mean, honestly, way up. We used to see on average 1.5 billion to 1.8 billion shares a day of Nasdaq volume. Last year's average, like the 10-day moving average heading into like December, was about 3.5 billion. So it was double what a real average has been for the last 20 years. Okay, and then what's happened is come December, and especially once January 1st hit, and I think some of this is related to a new year of tax implications, right? You get free of last year, and now people can free up some money and do some different things. Now it's really jumped to the point where I think in February at one point, the 10-day moving average of Nasdaq volume was 8 billion shares a day. Okay, which is a massive number, but nowhere near it's almost 6 times what a real true normal average is. So what we're seeing now is, Nasdaq volume, for example, this last week has been back down to about 4 billion shares a day. That's still higher than a big chunk of last year, and definitely higher than the normal average. I think what we're seeing is volume coming back to where it's traditionally been historically, but certainly down from what we've been seeing over the last 4 months or so.
Do you have concern that this is like a low volume rally where all the participants are already in and there's nobody left to buy? Because that's where my head's at.
It could be, but just keep in mind it's rotation too, right? So if they're coming out of some stocks, that money's freed up to go back into other stocks, right? It certainly is the case that there are stocks out here that are overvalued and have been for a while. But remember, the market can continue to move much longer than you can continue to fight it, right? Yeah, so if you're going to try to be short a market that's continuing to rise, you can lose that game. But just remember, the volume can come out of a series of stocks. When they need to raise money, what do? They sell Apple, right? Because there's just so much money in Apple. It's easy to go out and sell a chunk of Apple to raise some money to pay for some of the things you need to go do. And then if Apple pulls back, they buy the Apple back, right? So it's stuff like that occurs. It doesn't necessarily mean you're going to get a lot of price progress, because like I said, I do think we're kind of overpriced in some of this stuff, but it doesn't necessarily mean that like there's some end coming just because volume is fading back that much, because it really historically we're still well above historical averages.
So I'm just showing here is a way to kind of visualize this in a simple way. This is the volume on the Qs over the last 2 years, and you look at pre-COVID what was going on, and then you look at the whole COVID jump, and then we actually saw strong volume in that. We saw recently, as you get into the year, start to see something. And right now, you're right though. This last little run up has been on really diminishing volume. But what does that look like compared to over a year ago? It's a little late right now. But one of the things I look at with this is what's happening. I agree with you, Chris. I think there's some concern. Are we topping out? Like there's like a lackluster movement. What I would say though is we're not seeing a lot of funds exiting. We're not seeing people moving. We got some lackluster action, but we're not seeing exodus. So I'm guardedly optimistic. But we'll see where things where things go from here. But yeah. It's a concern. It's a concern, and it's something again. Back to that. How do we address these? Keep a tight eye on. It doesn't mean don't make the move, but if it doesn't work the way you expect, get out quick and set yourself up with the appropriate risk factors on what you're taking on in your trades.
Well, it's also reasons to trade options and not just to own stocks outright, right? I mean, that's what the whole point of options is that we're not as impacted by every little thing. And going back to what Rance said earlier, let's not just take bull call spreads on every stock we like, right? Let's have a couple of different strategies. And one last thing, I know we're probably cutting short on time here, but one thing I thought, Rance, maybe you could show is pull up one of these stocks that has earnings in the next week or two and let's do a snapshot comparison of 2 different strategies just so they can see visually how we could compare, what if we're looking at a bull call spread versus some kind of a straddle, or take your pick, whatever you like. And compare. You can see them both on the chart, so you can see the risk graphs compared, and you can play with the implied volatility as well, because really, to me, earnings comes down to playing the implied volatility one way or the other. You're either looking for the low implied volatility on stocks that you expect it to rise coming into the last couple of days before earnings, or you're looking for stocks that already have high implied volatility, but then that kind of gets into that condor world that gets a little bit sketchy sometimes.
Yeah.
But if we just pick 1 or 2 real quick and show on the platform, I think this is really important, because I love fiddling around with this myself in this platform. Just to compare just strategies, you learn so much about where the risk levels lie by doing stuff like this.
So what I happen to have up here real quick is I brought up Baxter. Here I have an implied volatility chart. It's right now, again, just cleaning this up so it's easier for people to see. Right now, it's still just slightly under the average, but it's pretty close to the average. And again, if you look at, I'm going to tell you, I can go back and verify, but those are going to be the earnings. Right. That's just going to be. So 38, 42, and we're sitting here at 27. So how would I want to approach something like that? Well, one of the things I could do is I could look at, do I want to maybe consider a straddle? And I'll take a snapshot of that. And then I can go in here and say, okay, well, instead of a straddle, what would happen if I went and did let's say a bull, 60. So let's say if I did a bull call, right? Actually, on this, I'd probably want to roll 75. I'd probably, see, actually going up here on these. By the way, it kind of tells you, like, look at how low these are. Well, actually, look at the bid asks.
Yeah, look at the spreads.
Yeah, look at the spreads. That's just like, that's a warning sign right there. So I wouldn't do that. I just happen to grab. I love the fact that normally I get a little chance to come up with do a little bit of the research, but you guys have thrown me a couple curveballs during this one. But you can see here very quickly, and if I want to size it appropriately, so it's kind of similar in what we got going here, right? So now you can kind of see. But the point I think that Chris was trying to make here is that I can look at this and see very quickly my outcomes here, where if I do the straddle play, I have to see it move in either direction quite a bit. The bull call spread here, I'm making money a lot quicker, although in this particular case, I'd still say that I don't like my risk reward ratio. But again, you can compare together here. You can actually do this with up to 3 trades. And then when you decide which one you like, all you have to do is just click whatever the color is, right? So if I got the red one and the blue one here, if I like the red one, click the red one, like the blue one, click the blue one, and then hit the trade button, it fills in the trade ticket.
Oh, that's cool.
To go. And so you can look at all, again, up to 3 trades.
But you can push the implied volatility on the comparison.
Right. Yep. So if I go back into this, I can start to see shifts in my implied and how it's going to play out over the whole thing. I can also look at, if I look at, days to expiration, I could do that as well. So I can get a better kind of indication, especially implied volatility, of the sensitivity of the trade around shifts in implied. So it's a really nice way to be able to compare different things. One of the really cool things about this is that, you can come up with your assumption of what you think, be able to compare them together and decide. And then, of course, the other thing that this does have in it, as we talked about, some of these that came out with earnings and had a tendency to move, had these high implied volatilities. And you want to see, well, okay, which one of these would have worked the last time? Right. So I could just go to backtest, go pick my date back in time, go structure those 3 trades, move the date forward, and see which one of those would have worked out for me.
Yeah. I remember you showing me that last time. My mind was blown. That was cool. It's
a pretty cool way to see, because I'll tell you that, Amazon tends to move around earnings. Right. There are certain stocks that tend to move around earnings. And so, you could, weigh out how that's playing out and be able to see how that would have worked out for you before, and be able to make the appropriate, assessment and have a much, much better sense of, how, what the odds are on it, and what my expectation of it is based on what's been happening in the past earnings cycles, and how this is going to play out this time. Right. So again, all you're trying to do is stack the deck in your favor a little bit, right?
Yeah,
and that's it. So if I'm looking at, hey, stocks are coming out with earnings that first week, what else, and they're doing really well, what else is coming up that's in that same sector? So that's one of the things that I would look at. Use that as your benefit. Doesn't mean it's going to absolutely play out, but it stacks again a little bit. Then look at a couple different strategies based on where the implied is and which one is going to play out better based on the potential rise in implied, or if it's already high, that implied falling and how that could affect the trade. So it gives you a chance to play with the past to see how it would have worked, to then make a better educated decision as how you want to approach it in this.
Yeah, that makes a lot of sense.
And the last one I want to say with this is, if it doesn't work, if you're playing earnings and it doesn't work the way you expect, especially with options, if you're owning the stock, you got a little bit more flex to this, but in options, if it's not doing what you expect it to, the earnings report day after earnings, get out, man. Don't keep riding something, hoping it's going to turn back around, because, the options have a limited life to them. And we've all had this happen in options, Chris. And I know from our previous conversations where you see a stock, it's going to go up, you buy the call option, expect to go up, and it does go up, just not in the timeline that you bought. Yes.
And that is a huge difference between stock and options, because at the end of the day with stock, you still have equity. At the end of the day with options, you got jack.
That's correct. Right. Then you got a risk reward ratio thing. You can make a lot more in the options, but it is a tool. One of the things I think about it is options can both be a leverage tool and a hedging tool. It's how you play it. And what a lot of new traders will do is they love the allure of the amped up returns that they could get on speculation, but they don't necessarily think about what can happen on the downside of that. And so, again, I think one of the worst things that can happen to a brand new trader is to have the first couple of trades work super well for them, because it just builds up that confidence, and then they end up not paying attention to things that they need to. So hopefully we've given some people some things to think about today on what to look at in earnings, and then, weighing out some of your decisions on how to be able to play it. So
we covered a lot. So before we go, let's make sure we send everybody over to marketgear.com/Chris Uhl. So you yourself can play around inside this platform that Ransom is demonstrating here. You'll get 2 weeks free and 50% off your first month when you do that. That's marketgear.com/Chris Uhl. That's me, CHRISUHL. And hey, listen, I really appreciate both of your guys' time going through all this. I mean, I can't imagine a better situation where I can sit and talk with really smart people like you guys and then share that with the audience. Because, we had one of our episodes, last I checked, I had hit 66,000 downloads and climbing. So there's a chance we'll hit six figures on that one. And just imagine, all those people are learning a little bit more about how to trade a little faster, and a little trade faster, a little trade smarter, and using that Market Gear platform as well. So thank you guys for your time. This is working out really well. I appreciate it.
Glad to be here, Chris. Always enjoy it.
Yeah, and thank you guys for tuning in to today's How to Trade Stocks Options podcast. Make sure you like, subscribe, and enable notifications. That way you never miss any of the tools, tips, and tricks we upload every single week to help you trade faster and trade smarter. And I'll see you next time. Okay, so what'd you think? That was pretty incredible, right? Now, if you like that, that's only a taste, only a sample of what you're going to find in the full AI stock trading system. And I really highly encourage you to go and check this out. Obviously, you are interested in learning on how to trade, and that's why you're listening to this podcast. Now, I'm going to take and download my entire trading system that I use day in and day out onto you. And the only way I'm going to be able to do that is over at the AIStockTradingSystem.com. You're going to get phase 1, 2, and 3, several bonuses, and on top of that, I'm going to walk you through over a dozen trades that I put on inside of my account, holding your hand and showing you exactly how I got in, how I got out, how I use the artificial intelligence data, and how this could work inside of your own trading portfolio on a daily basis. So make sure you head on over to AIStockTradingSystem.com. That's AIStockTradingSystem.com to learn more and to get started and to download my decade plus worth of trading experience into your hands so you can start using the AI stock trading system today, the 5-step system to take the guesswork out of trading. Hey, if you like this video, let me know by leaving me a like below, and then subscribe and share it with somebody you think could use it as well. Be sure to comment below with your biggest takeaway from this episode and any suggestions you have for future episodes. And finally, make sure you watch these other videos to help you trade faster and trade smarter, and I'll see you on the next episode.